On April 29th, the Pentagon told Congress that the first 60 days of America's war with Iran had cost roughly $25 billion. 2 weeks later, on May 12th, Pentagon comptroller Jay Hurst quietly revised that figure up to $29 billion. Defense Secretary Pete Hegseth is reportedly weighing a request for substantial supplemental war funding, separately from his proposed $1.5 trillion Pentagon budget for 2027, though no formal figure has been publicly confirmed. And according to Linda Bilmes, the Harvard economist whose previous work pegged the true cost of the Iraq War at $3 trillion, the all-in price tag of this conflict is already heading north of $1 trillion. So in this video, we're going to explain why that gap matters, and why the bond market, not the Pentagon, is the one that's about to break. If you love staying informed and want some of the best reporting on YouTube, then subscribe and ring the bell for more. First, though, it's worth understanding what the official $29 billion figure actually covers, because the methodology is doing a lot of work. According to the Pentagon, roughly $24 billion of that total is tied to munitions replacement and equipment repair, with the rest covering general operational costs. Crucially, though, the inventory is being valued at historical book cost, not current replacement cost, which is the core of Bilmes' objection. For context, independent analysts estimate the conflict has consumed around 1,200 Patriot interceptors, 1,000 Tomahawk cruise missiles, and roughly 1,100 long-range stealth cruise missiles in just over 10 weeks. More Patriot interceptors were fired in the first 4 days of this war than were supplied to Ukraine over the previous 4 years combined. Replacing those stockpiles at 2026 market prices, with strained defense contracts at Lockheed and Boeing, is a fundamentally different number from what's currently on the Pentagon's books. On top of that, Bilmes' $1 trillion estimate folds in lifetime health care for the roughly 55,000 troops exposed to toxins, reconstruction of at least 9 damaged U.S. bases across the Gulf, and a short-term burn rate she puts at around $2 billion a day. Some independent analysts applying broader economic methodologies place the total cost significantly higher than official Pentagon figures. Anyway, this brings us on to the Treasury, which is where the real problem lives. The U.S. is already running a roughly $2 trillion annual deficit. Debt held by the public has crossed 100% of GDP for the first time since World War II, and net interest payments hit $628 billion in just the first 7 months of fiscal year 2026. That's about $3 billion a day, every day, just to service existing debt. On May 6th, the Treasury announced a $125 billion quarterly refunding and projected $189 billion in new net borrowing for the second quarter alone, with full year 2026 issuance now tracking $2 trillion. And primary dealers are openly briefing that nominal coupon auction sizes will have to step up significantly in early 2027. The trouble is, this supply is hitting the market at the exact moment foreign demand is structurally retreating. Chinese holdings of treasuries have fallen sharply over the past several years, declining from a peak of over $1.3 trillion to roughly $693 billion as of early 2026, as Beijing continues to diversify its reserves. The share of foreign treasuries held by central banks has declined significantly over the past decade, with private investors, including leveraged hedge funds, increasingly filling the gap, positions that can unwind violently under stress. So the obvious question is, why can't the Federal Reserve simply absorb this supply through QE the way it did in 2020? Well, this is where the Fed becomes the most interesting actor in the story. Headline CPI hit 3.8% year-on-year in April, the highest reading since May 2023, and producer prices, which tend to lead consumer prices, jumped 6% over the same period, the largest annual gain in roughly 3.5 years. Brent crude is sitting around $107 a barrel, gasoline is averaging $4.50 a gallon, and Kalshi prediction markets are pricing a roughly 40% probability that CPI breaks above 5% before year-end. With Kevin Warsh, a documented hawk, being confirmed as Fed chair this week, traders have effectively removed all 2026 rate cuts from the curve and are now pricing between a 30 and 37% probability of a rate hike before year-end. Monetizing a fresh $1 trillion of war debt into that backdrop would, as Henry Paulson warned recently, only accelerate the spiral by destroying confidence in the dollar. Jamie Dimon has been blunter, warning of an outright bond crisis where the Fed is forced to act as buyer of last resort. Either way, The bond market is being asked to swallow this issuance largely on its own. The closest historical analog, as we see it, isn't the COVID stimulus or even Iraq, but the run-up to 2008, when nearly $1.1 trillion in irregular cash management bills and an additional $313 billion in off-balance sheet stabilization costs accumulated quietly in the background before the system was forced to acknowledge them. The 30-year Treasury yield has already breached 5%. The 10-year is sitting at 4.49%, the highest level since July 2025, and the term premium that Fed purchases suppressed for over a decade has, in the words of one strategist, reasserted itself with a vengeance. Whether Hegseth ever submits a formal supplemental, whether the ceasefire that Trump described this week as being on massive life support actually holds, and whether China resumes Treasury buying after this week's Beijing summit all remain to be seen. What's already clear is that the math on the official $29 billion figure no longer ties out, and the bond market, sooner or later, is going to be the one to call it.